Hello and welcome. Welcome back to Accounting 201. I'm your host, Dr. B. Today we're going to cover chapters 5 and 6. Chapters 5 and 6 has to do with retail businesses. These would be companies like Macy's or any other store that you like to buy things from, like Amazon or Walmart or any store at the mall or, retail. So today we're going to talk about retail businesses in general. We'll talk about how retail businesses accomplish their accounting needs, and we'll also talk about that fun thing called inventory and how to account for it. Before we jump into all of that great stuff, I want to have a few housekeeping announcements. As you go into the classroom, these chapters 5 and 6 are covered in Module 2, Week 3. We are in the third week of our course together. What does that mean? Week 1, we covered chapters 1 and 2. Week 2, we covered chapters 2 and 3. This week, we covered chapters 1 and 2, week 1. And week 2, we covered 3 and 4. Today, we're going to do 5 and 6. Next Tuesday, 7 and 8. At the end of week 4, that means we've made it halfway through this course. At the end of week 4, we've made it halfway through this course. What that means is that we have our midterm exam, okay? I want you to be very aware of what is going on in this course. As you know, we normally do not accept late work. Some of you never bothered to complete the Chapter 4 discussion forum, okay? You cannot make that up. I will not allow any points for late discussions. You can't have a discussion with yourself. It's not a discussion. So if you did not participate in the Chapter 4 discussion board, which was due this past Sunday, you earned 0 points for that. It's out of 5 points. Now, it sounds low, okay? It's not. It's 5% of your total grade. That means you dropped half a letter grade by not completing that discussion board. Okay, so if you didn't complete the discussion board, you didn't earn any points, and you won't earn any points. So you missed half a letter grade. Oops. It's very important that you please make sure that you complete all of the work in this course, not just quizzes and homework, because you won't pass if you don't participate in the discussion forums. There's 3 discussion forums. That's 15% of your total grade. There's a good chance you won't pass if you don't participate in those. So please, make sure you do it. Okay, the Chapter 3 quiz was also last week. Okay, that brings us to this week. This week, what do we have? We have the Chapter 5 quiz, due on Sunday night, and we have the Chapter 6 homework assignment, due on Sunday night. That's in Cengage. If you are having trouble accessing the homework or your textbook in Cengage, you need to do the following things. Number 1, make sure you're only accessing Cengage through Blackboard. Log out of any Cengage sessions that you have open, come into Blackboard, select the homework assignment, and it'll open up Cengage that way. That is the only way you can access Cengage textbook and homework assignments is through Blackboard. The system will not allow you to access it any other way. Okay? That's how it links directly to the class. That's how it links to the gradebook and all that good stuff. And then here you'll just select assignments and then select your respective assignment. To access the textbook, you select this button at the top right. It says Study Tools. Select Study Tools and then select e-book. It will open up the textbook. That is the only way, again, that you can access the textbook and access the assignments is through Blackboard. So please, if you're having trouble doing that and it comes up with a prompt asking you to pay or something ridiculous, you need to contact me through email and I will contact Cengage for you. Okay? Yes, good. All right. So if that's the case for you, please make sure that you notify me of that. I would appreciate that. Okay, I'll get off my soapbox. Okay. So Richard asked if the assignments disappear automatically if they're past the due date. The answer is no. You still have access to those assignments even past the due date. So you should still be able to access your assignments even past the due date. Through Blackboard only. Good question.
Will we still get a partial credit for assignments being late?
Yes. Yes, please. Yeah, and I strongly recommend that you please complete any past due homework assignments or quizzes. But I will not allow points for any past due discussion forums. You can't have a discussion by yourself. Good question. Absolutely. Okay, great. If you're having trouble, if you don't have access to an access code, or you're having trouble with whatever trying to get through, again, the only way you can access Blackboard, the Cengage is through Blackboard. There's no other way. There is no access code. Okay, there is no access code. You access it directly through Blackboard. That is your access means. So no access code. You just simply go into Blackboard, select the homework, it opens up. If that's not the case, if it's saying you need to pay and you already did the trial thing, you need to email me and let me know so that way I can directly contact the folks at Cengage. Okay. I'm sorry, I need to get off that topic. But if you're still having trouble, you need to email me so that way I can get you access. Okay. Let's jump into the chapter, shall we? This chapter 5 is super long, but I promise we're going to jam through it. There's some really boring parts, but we'll get through it. Go ahead, David. Do you have a question?
No, sir.
Okay, great. Thank you. As always, if you have any questions as we go through the content, please feel free to unmute yourself and ask your question. There's a good chance that some of your classmates may also have the same question. Okay, let's get rocking and rolling. So again, Chapter 5 has everything to do with retail businesses. So does Chapter 6. Chapters 5 and 6, we talk about retail businesses. An example of that would be like Macy's or Amazon or anywhere else where you buy physical products. Those are called retail businesses. I'm sure most of you know that, though. Okay. Activities of retail business are ones that sell physical products. Okay. Those are different than service businesses. A service business is a company that provides you with services. An example of that would be a dentist, a lawyer, an accountant, somebody who mows your lawn. Those are service businesses. Okay. A retailer is somebody who provides you with physical products. So there's going to be a couple of differences in the way that they operate and how their financial statements appear. First, let's talk about the operating cycle. The operating cycle for a retailer, they spend cash, generate revenue, and receive cash from customers. The way it works is that a retailer will sell you a product, you then pay for that product. Right? Very simple. Whereas a service business, they provide the service, you pay for the service. Here's the operating cycle. The business uses cash to purchase merchandise. The merchandise is delivered to the company. The company then sells it to you. Okay? When the company sells you the merchandise, they record it as accounts receivable. And then they collect the cash, and then the cycle repeats itself. They use that cash to then buy more merchandise, to then sell more merchandise, to record accounts receivable. Then they collect the cash from you again, and then they go buy more merchandise, and so forth and so on. That's called the operating cycle of the business. Time and days to complete the operating cycle is going to be different among all retail businesses. Some retailers, they require you to pay right then and there. An example of that would be like a grocery store. You can't leave the grocery store by putting it on accounts receivable, right? It's like you have to pay for your groceries at the time of the exchange. So their operating cycle is very short, right? Because they don't have to wait for cash. So a business like a grocery store, the operating cycle is a lot shorter. You pay them the cash, they take that cash, they put it in the bank, then they buy more merchandise, and the cycle repeats itself. Very, very short. Some retailers, the operating cycle is a little longer. An example would be you purchased some jewelry from Macy's on account, using your credit card, and then you're gonna pay that over time, using the store card, I should say. You're gonna pay that over time. So their operating cycle is a little bit longer. Let's talk about the financial statements. On the income statement, you all remember the income statement. At the very top of the income statement, you have your sales, your revenue, right? Then you have this thing called cost of goods sold equals gross profit minus operating expenses equals operating income or net income. So at the very top, you have your revenue. For a service business, their revenue is called fees earned. For a merchandising business or retailer, their revenue is called sales. For a service business, they have, and a merchandising business, they both have operating expenses and operating income. Here's the difference. At a merchandising business, we have our sales, then we have this line item called cost of goods sold. Cost of goods sold. What cost of goods sold is the cost of the inventory to the business to sell it to you. The cost of inventory to the business to sell it to you, that's cost of goods sold. Okay, when they sell you that new TV that you bought over at Best Buy, when you bought that new TV, and you bought it for like $1,000, it cost them about $200. Okay, and so their sales will be 1,000, their cost of goods sold will be 200. So 1,000 minus 200 is $800 of gross profit, and then they'll have some operating expenses. And then they'll have their net income. That's the way a merchandising business income statement appears. Sales minus cost of goods sold equals gross profit. Something weird just happened. Hello, are you all there?
Sir. Okay, Professor.
Okay. For some reason, my screen share just randomly decided to stop.
Hey, Professor.
Yes.
I had a question. So the cost of goods sold, that's basically like how much the retailer spent on that product.
Yes, David, that's correct. Absolutely. Yep. Great question.
That's how much they bought it at wholesale, basically.
Yeah, exactly. Yeah, and that's typically the way most business operate. So let's say you have a clothing line that you sell. So for your business, especially with clothing, you'll typically mark up the cost and that'll be your sales price. Right. So for example, let's say you have a clothing line that you sell and you specialize in jeans. Okay. And so you'll buy a pair of jeans from your wholesaler. You'll buy like in bulk.
Right.
Let's say you bought each pair of jeans cost you $10. You'll sell that for $40 will be your sales price. How'd you get to $40? Well, you decided you want $30 of profit, right? And so you sell the jeans for $40 minus your cost of goods sold. That's how much you paid for that pair of jeans to sell it, right? So $40 minus the 10, gross profit's 30, and then you'll have minus your expenses, and then will equal your net income or your operating income. Yeah, good question.
Professor.
Yes, please.
The cost of goods sold, where will shipping and handling go? Would it go under there or operating expenses?
Operating expenses. Good question, Mike.
That's if you offer free shipping and handling, because if the customer have to pay for shipping and handling, that will go up there with. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If you offer free shipping and handling, because if the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses. If the customer have to pay for shipping and handling, that will go up there with operating expenses.
It'll be included with your revenue. Yep.
Right.
If it's included in if the customer pays for shipping and handling, that's part of your revenue. If you pay for shipping and handling, that'll be your expenses.
Right.
Yep. Yeah, good question. Actually, we'll get into that as well. Very good. Okay, so the revenue activities for service businesses involve providing service to your customers. The income statement, we call that fees earned. We talked about that. And then you subtract out your expenses to get to operating income. That's for a service business. But for a retailer, which is what we're talking about today, your revenue is called sales. The cost of goods sold is also known as the cost of merchandise sold. Cost of goods sold is also known as cost of merchandise sold. So sales minus your cost of goods sold equals gross profit. Gross profit is what you get to before your operating expenses. Okay, so and it's always going to be in that order. So the formula is sales minus cost of goods sold equals gross profit minus operating expenses equals operating income. So sales minus cost of goods sold equals gross profit minus operating expenses equals operating income. And and just so you know, every income statement for every retailer, it's formatted the same exact way. You'll always have revenue on the top minus cost of goods sold equals gross profit, and then minus their expenses equals operating income. Every single retailer has it formatted the same exact way. And it makes it nice and easy for us investors. Okay, so let's talk more about the merchandise. Merchandise on hand, meaning we haven't sold it yet, we call that inventory. Inventory. It's also known as merchandise inventory. Inventory is what you have available for sale, but you haven't sold it yet. We call that inventory. It's available for sale. You have not yet sold it. It's called inventory. And inventory is found on your balance sheet under current assets. Current assets. Inventory is called a current asset because we expect to sell it within 12 months or less. Okay, let's talk about the chart of accounts. You all probably remember chart of accounts from the first two chapters. We talked about chart of accounts. The chart of accounts is the list of all accounts that the business has. We first start out with assets and then liabilities, and then we get into our revenues and expenses, and we go down the list, right? The chart of accounts shows us the list of accounts that the business uses. And what you'll find is that for merchandise businesses, you're going to have a few new few new items in your chart of accounts that you may not have seen before. So, and those include on the balance sheet, you'll have, of course, you have your assets, which include cash, accounts receivable, inventory, estimated returns inventory, office supplies, prepaid insurance, store equipment, so forth and so on, right? These are all assets. Now, you'll notice a couple of things I want to point out to you. Assets, the category, that's a category, right? It's 100. Within assets, we have cash, accounts receivable, inventory. We see that the account number for cash is 110, accounts receivable 112, inventory 115. There's a second one. Think of it this way. It's called. Think of the parent account is the assets. The children accounts are those assets. The individual assets. The parent account is the asset category. The children accounts are the subcategories or sub-accounts. So if you look at the numbering process, assets 100, cash 110, 112, 115, so forth and so on. That first one represents asset. And that next digit represents the order of that asset. Okay, so I want to point out a couple things. Inventory, 115. Inventory, you'll only find that for a retailer or a manufacturer. You'll never find inventory for a service business. Inventory is only for retailers or manufacturers, not for service businesses. Estimated returns of inventory, what that is there's a certain amount of inventory that we expect that will be returned to us. So, for example, let's say you sell you're selling jeans in your store, and customer goes, they buy the jeans, they go home, they try it on, they don't fit, so they're going to return it. We're going to estimate an amount that we expect will come back to us each month or each year. That's what estimated returns of inventory are. We have office supplies, prepaid insurance, store equipment. This would be things like at a clothing store, they have like folding tables, and they're designed to help you fold up the clothing. That would be part of store equipment. Okay, under liabilities, which starts with 200, we got accounts payable, salaries payable, unearned rent. This one right here, 213, customer refunds payable. Customer refunds payable. Customer refunds payable is the customer buys a pair of jeans from you. The customer buys a pair of jeans from you. They go home, they try it on, doesn't fit, they come back, you issue them a refund. That's a refund is considered to be a liability, so it'll go being customer refunds payable. Then eventually you pay the customer back. Lynette, question? Are you okay?
Oh, I'm sorry.
That's okay.
Oh, I do have a question.
Go ahead, Lynette.
I do have a question in regards to the how we identify each account with the numbers. Can we make up our own numbers, or there is literally a system how we are supposed to go by?
Yeah, there's a system.
Okay.
Yeah, so assets always start with 1. Liabilities will always start with 2. Your equity will always start with 3. Revenue will always start with 4. Expenses will always start with 5. And then there's a couple of other odd ones. But yeah, and that'll be given to you. Good question.
And that's a rule of accounting.
It is, yeah. Yep.
Okay. All right.
Yeah, good question. Okay, so where are we? Customer refunds payable, that's unique to retailers. Let's see. I'm trying to think of other ones that are unique to retailers. That's really about it. Okay. Subsidiary ledgers. We talked a little bit about the ledgers, general ledgers, subsidiary ledgers. We talked a little bit about this in the first 2 chapters. But to recap, for each customer and creditor, that we add them to the ledger. The ledger becomes large and awkward to use when there's a lot of different creditors and customers. So because of this, we create what we call subsidiary ledgers. These are a large number of individual accounts with common characteristics. Just like I showed you here, I want you to think of it this way. The asset account is a ledger. Cash, accounts receivable, inventory, so forth and so on, those are subsidiary ledgers. So remember that relationship I said. You have parent account and children account. Parent account is the general ledger. Subsidiary ledgers are the children. It's a nice way to think about it. Primary ledger that contains all the information on the balance sheet and income statement accounts are called the general ledger. These are just terminology. Yeah? Each subsidiary ledger represented on the general ledger is called the controlling account. It's just names. It's just names that you need to. It's in the glossary, but it's good to know these types of names, because just like we said earlier, accounting is a language of business. So there's a ton of different terminology that you kind of need to know. Some of all the balances are reported on the balance sheet, as you know. Common subsidiary ledgers include things like accounts receivable. Accounts receivable is a subsidiary of assets. Accounts payable is a subsidiary of liabilities. Inventory is a subsidiary of assets, so forth and so on. Most retail companies use a computer system. No kidding. We call to record transactions. You know how they have that little barcode reader? That's a computer system. And when we scan the barcode, the computer recognizes the sale, and it's automatic, which is really cool. That gets recorded in what we call a special journal. Okay, purchase transactions. The business, the retailers, they need to purchase their inventory from somewhere, okay, usually from a wholesaler. And then, of course, they're going to sell their inventory to the customer, right? To record these transactions of selling inventory, the company will utilize one inventory system, one type of inventory system. They'll either use the perpetual inventory system or the periodic inventory system. In a retailer, most large retailers that sell inventory constantly, an example of that would be Walmart, Best Buy, Amazon, you name it, right? A grocery store. Those types of businesses typically will use the perpetual inventory system. The word perpetual means continuous, right? Perpetual. The word continuous. The perpetual inventory system helps the retailers to track the sales continually, yeah, and to help them to update the inventory records. So let's say you're Best Buy and you sell electronics, right? And you sell, we'll say, DVDs. In order to track the sales of DVDs, they use a perpetual inventory system, and they'll scan the barcode of each DVD. And when they scan the barcode, it takes it out of inventory because it's no longer available for sale. It's being sold, right? That's what they mean perpetual. The other type of system that retailers will sometimes use is called periodic. Periodic inventory systems are used by companies that do not sell frequently. An example of this would be Zales Jewelers, a jewelry company, a specialty store that sells specialty products, and they don't have a whole lot of them on hand. They will use a periodic inventory system. What that means is at the end of each month, they will do a physical inventory of what they sold and create a journal entry for those sales. That's why they call it periodic. They do it periodically, once in a while. So let's take a look at some examples. So physical inventory is prepared at the end of the accounting period. Typically at the end of a month, a quarter, or a year, or a half, or sometimes twice a year, most businesses, even large retailers like Walmart, Macy's, whoever, right? They'll do a physical count of inventory. And the reason why they do that is to make sure that what that says that they have on hand actually exists. It's actually there, right? They call it a physical count or physical inventory. They physically count and then they add up the cost of goods sold to make sure it matches. This is also very common in the perpetual inventory system. An example of a perpetual inventory system transaction is we would, or in this example, we're purchasing more inventory from our supplier, okay? We're purchasing more inventory from our supplier. When we purchase inventory from our supplier, we debit inventory. To increase our inventory, we debit inventory. In this example, 2510. And we're going to credit cash, 2510. So we're purchasing inventory for our company to then later sell. We're purchasing it from our supplier. So we debit inventory and we credit cash. That's the journal entry that we would make. Now, if we were to purchase that inventory on account, meaning we're going to purchase that inventory, but we're going to pay for it later on account, we would debit inventory and credit accounts payable. We would debit inventory and credit accounts payable. That's if we're purchasing inventory on account. Remember, on account means I'm purchasing it now, but I'm going to pay for it later. So later on, I'll receive a bill in the mail from my supplier, and they'll say, hey, pay me within 30 days or whatever. That's called an invoice. That bill is called an invoice. Here's an example of an invoice. It'll have the name of my supplier. It'll have my company's name under sold to, the order number, the date that I ordered it, the date they shipped it to me, how it was shipped, what the terms are to pay it, the invoice date, where it came from. If it's FOB, this we're going to talk about the shipping stuff. How many I ordered, what it was, what the unit price is for each one, and the total amount. Now, a couple of things I want to point out to you on this invoice. Terms. Okay, terms. Terms. This one says 210 net 30. 2/10, comma, n/30. This means 210 net 30. Here's what it means. If when I receive my bill, if I pay this bill within the first 2 days of receiving that bill, I'll receive a 10% discount. That's what 210 means. So terms, 210. When I receive this bill, if I pay this bill within the first 2 days of receiving the bill, I can receive a 10% discount. Otherwise, it's the entire bill due within 30 days. That's what 210 net 30 means. 2% discount if paid within the first 10 days. Or, I'm sorry, paid within the first 2 days, 10% discount. Net 30. We'll talk more about that. Because there's different terms, right, for different companies. Or actually, I'm sorry, it's a 2% discount if paid within the first 10 days. 2% discount, I had it backward. 2% discount if paid within the first 10 days. Otherwise, it's due within 30 days. Then there's this other thing I need to point out to you. FOB, Cincinnati. The word FOB means free on board. Free on board. Free on board. What free on board means is that the seller is responsible for the shipping. And we're going to talk more about that. We'll talk about FOB, and we'll talk about other methods of shipping and who's responsible for it while it's in transit. So that's an example of an invoice. Let's talk about it. Let's break it down a little bit further. So earlier I showed you that 210 net 30. 2% discount if paid within 10 days. Otherwise, it's the whole thing is due within 30 days. We call those credit terms. Credit terms. These are terms for payments for merchandise. We call those credit terms. If the payment's required on delivery, we call the terms are cash on delivery. Cash on delivery. Otherwise, buyers allowed a certain amount of time. We call that a credit period. So when you see N-30, that means you have 30 days to pay that bill. That's called the credit period. Credit period usually begins with the date of the sale as it's shown on the invoice. Purchase discounts. So I'm going to break down what we talked about earlier, the 210 net 30. So what a lot of retailers or suppliers will try to do to encourage the retailer to pay quicker is sometimes they'll offer an upfront discount. They'll say, hey, you know, I ordered that shipment of jeans, right, for my clothing company. I sell jeans. So I ordered some jeans from my supplier. The supplier said, hey, you know what? If you pay me within that first 10 days, I'll give you a 2% discount. So that type of thing encourages people to pay faster. In business, we know that cash flow is super important, right? We need cash in order to do things. So the same applies for suppliers. Suppliers need cash. And so in order to encourage their customers to pay faster, they'll offer a discount. So in this case, 2% discount if they pay within the first 10 days. Otherwise, the entire balance is due within 30. That's what all this means, 210 net 30. Any questions on that? You're all good?
I have a question, Professor.
Yes, Pavle.
I mean, are we need to give them discount, or can we do it without that?
No, they don't have to give you a discount. You don't have to give them a discount. But what discounts do is they incentivize the customer to pay to pay you faster. So if you offer a discount up front and you say, hey, you know what, if you pay me within the first 10 days, I'll give you a 2% discount. What that does is it incentivizes you to pay me faster. But you don't have to. You don't, and you don't even have to offer a discount. But sometimes it's good, especially if you're short on cash and you want to get cash quicker, you might offer a discount. Does that make sense? I can't hear you, but I hope you're saying yes. Pavle? And for some reason, I can't hear you. Okay. I'm just having some technological issues. Okay. Everyone's good on this concept? Yeah? Okay. Now, looking at those credit terms a little bit further. So the invoice date was January 5th. The discount period is from January 5th to January 15th. That's 10 days. So if the customer pays within that first 10 days, they get a 2% discount. How do they compute the 2% discount? Well, it's 2% times 3,000. So it'll be 3,000 minus that amount. Gets 2,940 is the amount that they would pay if they were to pay within that first 10 days. So 3,000 times 2%, and that'll be 3,000 minus that amount. It's 2,940 because what is that? $60 is the discount amount. $60 is 2% of 3,000. So if they pay within the first 10 days, they'll pay 2,940. Otherwise, if they don't pay within, and it's due February 4th. Yeah. Cool. Okay. Discounts work both ways. Purchase discounts are taken into consideration for a buyer for early payment. The idea behind a discount is to encourage people to pay early. That's why people offer discounts. Purchase discounts can be taken by a buyer to reduce the total cost of the merchandise paid. So going back to our earlier example, if our company purchases some supplies and we say, and with the bill it says 210 net 30. So if I pay within that first 10 days, I would only pay 2,940 because 2% of 3,000 is $60. So 3,000 minus 60 is 2,940. So my bill would be 2,940 if I pay within the first 10 days. Otherwise, I would pay the full $3,000 within 30 days of the bill. That's basically what all of this is telling you. It's just kind of working through the example. There's a couple of different ways to analyze it. So how do we know how much we're saving if we utilize the discount? If we utilize the discount, we pay within that first 10 days. Of course, we know that we would save $60 off the total bill. If there's an interest rate associated with the balance, we'll say, if there's this interest rate associated with the balance. Let's say there's an annual interest rate of 6%. Okay. If there's an annual interest rate of 6% and the total payment amount $2,940, 6% of that is $9.80. So $60 minus $9.80 will give you a total savings of taking the discount of $50.20. That's if there's an interest rate associated with the total payment. Terms of the purchase normally indicated on the invoice. So it'll usually say what the terms are. If it's 210 net 30 or just net 30 or net 45, net 60, whatever it is. This kind of gives you an idea. Buyers normally take all purchases. Buyers typically will take a purchase discount. I always try to do the discount whenever possible, right? It's good to save money wherever you can. Inventory is debited from the net purchase price under the perpetual inventory system. So what does that mean? So instead of recording a total inventory price of $3,000, I would record an inventory price of $2,960 because of that discount. Or 940, sorry. So here's how it works. If I take advantage of the discount, I debit my inventory 2,940 to increase my inventory. I credit accounts payable 2,940 to increase accounts payable. I do that on January 5th because that's when I placed the order. That's when I received the order. Now I have to pay them within that 10 days in order to take advantage of that discount. So on January 15th, I need to make sure I pay them. So I would debit accounts payable to reduce accounts payable, and I would credit cash to reduce my cash by that same amount. If we do not pay within the discount period, okay? Let's say we decide, you know what, we're not gonna take advantage of that discount after all. You know, we're gonna pay them after that 15 days, or we missed the discount period, right? We would debit accounts payable 2009-40. We would we would debit inventory by 60 to increase it up to that $3,000 amount, and we would credit cash by $3,000 to represent the payment of cash. Returns and allowances. Oh man. You know, as a retailer, I don't like returns because usually when merchandise comes back, something wrong with it, it's either defective, damaged, customer didn't like it, didn't fit properly, whatever. Returns always cost the company money, typically. Reason for returns is it's damaged, defective, customer didn't like it, whatever the reason is. We have an account called Purchase Returns and Allowances. And so what this account is it allows for returns to be recorded. We need to record returns because every time a customer returns merchandise, we have to reduce our sales by that amount, and we also have to increase our inventory by that amount, assuming that it's going back into inventory. And we use the Purchase Returns and Allowances account to do that. The buyer normally sends the seller a debit memorandum. We call this a debit memo to notify reasons of the return. So think of it this way. Let's say you bought a pair of jeans, you brought it home, doesn't fit. You bring the pair of jeans back to the store. The store asks you, why are you returning this? You say, it doesn't fit. What the store will do is they'll record what they call a debit memo. It's the reason for the return. Yep. It informs the seller of the amount of the purchase to debit the account payable due to the seller, assuming that they paid on account. Here's an example of a debit memo. So let's say our company deals with networks, networking solutions. We received some network cards that are not according to the specifications that we ordered. So we don't need them, right? There are 10 of them. So we send 10 of these network cards back to our supplier to say, hey, you know what? We don't need these for whatever reason. So we sent 10 of them back. They cost us $90 a piece. That's $900. This is an example of a debit memo. It's the reason for us returning this product. The buyer may use the debit memo as a basis for recording the return of allowance approval. In this case, the buyer debits accounts payable to reduce the accounts payable and credits inventory to put it back into inventory. So we debit accounts payable to reduce the accounts payable amount, and we credit inventory to put it back into inventory. Before we pay an invoice, a buyer may return an inventory and be granted a price allowance using a discount. So here's what this means. Let's say, I'm going to return some of this inventory because I don't like it or I don't need it. Oftentimes, what will happen is the person that sold it to you will say, hey, you know what? Instead of sending that back to us, we'll just give you a discount instead. That's what this is. Or they'll say, and so, it's like let's say you ordered like 100 pairs of jeans, and 10 of them had a defect, and your supplier will say, hey, you know what? Instead of sending those 10 jeans back to us, we'll just give you a discount on your total order. So when that happens, the amount of the returns recorded at the invoice amount minus the discount. So this way, we are recording the discount on those 10 defective jeans. So here's an example. Our company was going to return some of those network cards. May 2nd, we debited inventory credit accounts payable for the initial purchase. On the 4th of May, we were going to send some of that back. And to do that, we would debit accounts payable to reduce accounts payable, and we would credit inventory to reduce our inventory by that amount. So instead of actually sending it back, they gave us a purchase discount, and with that purchase discount, we reduced the value of the inventory by debiting the accounts payable $980 and crediting inventory $980. And so we still need to pay the company for the amount of inventory that we received on May 12th. So what we did is we debit accounts payable $3,920. That wipes out the entire payable, and we credit cash $3,920. The reason why $3,920 and not for the $4,900 is because $980 of that we received a discount on. When a retailer sells the inventory, we record it to sales. So we would credit sales, right? Debit inventory, credit sales. Sometimes the merchandiser will call sales of merchandise, especially if they have multiple line items of revenue. Okay. March 3rd, our company sold $1,800 worth of merchandise. So here's the transaction. We debit cash because we're receiving $1,800 in cash, and we're crediting sales $1,800. When we credit sales, we're increasing sales. When we debit cash, we're increasing cash. Now, what about the transaction for the inventory that we actually sold, right? Yes, go ahead. Oh, you want me to say that one more time? Sure. So, our company sold some merchandise. We sold some of our inventory on March 3rd. We debit cash because we're receiving cash from our customer at the time of the sale by $1,800. When you debit cash, that means you're increasing cash. We also need to reflect that we sold merchandise to receive that cash. So we credit sales by the same amount to increase our sales amount. So debit cash to increase cash. Credit sales to increase sales. There's a second transaction that needs to happen, of course, to reduce our inventory. And I'll show you what that looks like. Using the perpetual inventory system, cost of goods sold and decreased inventory need to be recorded. So here's what it looks like. Now remember, I sold $1,800 worth of inventory. I increased my cash because I got cash from my customers, and I increased my sales by that same amount. Now I need to record I need to reduce my inventory because I just sold that inventory, right? So to do that, I debit cost of goods sold to increase cost of goods sold, and I credit inventory to reduce the inventory. Make sense? Yeah? Yes, no, maybe? You all can still hear me?
Yes, sir.
Great, wonderful. Very good. So here's how I want you to think about it. Every time that you make a sale, there needs to be 2 transactions, okay? Every time you make a sale, there needs to be 2 transactions. You'll debit cash or accounts receivable if you sold it on account, and you'll credit sales. The second transaction is you'll debit cost of goods sold. Remember, that's the cost of the inventory that you paid for, the inventory, right? And you'll credit inventory to represent the sale of that inventory. David, does it make sense or you have a question?
So what goes out is credit, and what comes in is debit.
That's typically, but that's only for assets. Yeah.
All right.
For assets, is what goes out is debit. I'm sorry. For assets like cash and inventory and all that stuff.
Right.
When you debit, that means it's coming in.
Right. Okay.
When you credit, it's going out.
Right. Okay.
But that's only for assets. It works the opposite for liabilities and equity.
Right.
Yep. Good question. Absolutely. Okay. Cash sales. It's important to recognize this. Even if a customer uses a credit card to purchase stuff from you, it's still cash. It works the same exact way. You're still receiving cash, right? So at the end of the night, the way it works is, let's say you or your business accepts cash and credit cards and debit cards or whatever, right? And it doesn't matter. We all recognize it as being cash. We record it as a cash sale. There's a small difference, very small difference. When a customer swipes their card, what happens is you have to pay a transaction fee. Okay? Not the customer, the business has to pay a transaction fee, right? Through a clearinghouse. They call it it's a processing fee, it's a clearinghouse fee, it's a bank fee, right? Come on, you already know the bank's got to make some money. So when the customer uses their credit card to pay you, you need to pay a transaction fee for them using that credit card. It's usually like 2 or 3% of the sales price. Okay? And so what'll happen is the credit card processing company will send you a bill to pay that fee. That fee, it's just an expense. We record it as a simple expense on the income statement. It's just a regular expense. It doesn't come out of your sales. It just gets recognized as a regular expense. So customer uses MasterCard to pay for their purchase. It gets recognized as a fee. It's just an expense, just a regular expense. So eventually you'll get a bill from the credit card processing company, right? You'll need to pay that, of course. So what you do is you debit credit card expense, which is just a regular expense on your income statement, and you credit cash. to represent the payment of that bill. Okay. Now let's talk about sales on account. We've talked about this in the past. We're going to keep talking about it. So when we sell something on account, when you hear the word on account, it means either accounts receivable or accounts payable. Accounts receivable, when you hear on account and we sold something, when we sell something and you hear the word on account, it means accounts receivable. That means that we'll eventually receive cash from our customer. So we put it in accounts receivable. On account, when we receive a bill and we haven't paid it yet, that's accounts payable. But today, right now, we're going to talk about accounts receivable. So our company, we sold some merchandise to a customer on account for $18,000. Okay, so we debit accounts receivable and we credit sales. We debit accounts receivable to increase accounts receivable. We credit sales to increase our sales. Remember, sales is a part of the equity on the income. It's on the income statement, so that's why it's a credit to increase sales. Now, of course, when I sell inventory, there's a second transaction I need to make, right? I debit cost of goods sold for the amount that the inventory cost the company. And I credit inventory. Make sense? And it's always going to be these, two transactions for every time that you sell inventory. Okay, customer discounts. Seller might issue a customer a discount for various reasons. We call these customer discounts. These are incentives for customers to purchase stuff, right? Think of it this way: you went to Macy's. They had a sale. That sale is called a discount, okay? And that discount incentivized you to buy it because nobody likes to pay retail price. So they go in and they buy stuff that's on sale. That sale is called a customer discount. Or you used a coupon to purchase something at a store, right? That coupon, that's called a discount, right? Retailers use these types of tactics to get customers into the store and to purchase in larger volumes or to purchase early. These are some reasons why we use discounts. Sales discounts also encourage customers to pay their invoice early. 210 Net 30, which we talked about earlier, provides a 2% discount on sales if the customer pays within 10 days. Okay, let's assume our company sold $18,000 to our customer. And we said, hey, customer, if you pay me within the first 10 days, I'll give you a 2% discount. Customer's like, yay, that sounds great. So they do that, right? So we debit accounts receivable, $17,640. How did we get that amount? The discount, the 2% discount. So $18,000 times 2%, $18,000 minus that amount is $17,640. So debit accounts receivable, $17,640. Credit sales, $17,640. Remember, this first transaction represents us selling the inventory to our customer. But we sold it on a discount because our customer is going to pay us within those first 10 days. This method of using sales discounts is called the net method. Another fun term. Net method. Customer pays us within that 10 days on March 19th. So we debit cash, because we're getting cash in, $17,640. And we credit accounts receivable, $17,640, to reduce the accounts receivable. If our customer decided, you know what, I'm not going to be able to pay you within that first 10 days, so I'll pay you later. And we're like, okay, that's fine. So eventually they pay us. We debit cash the full amount, $18,000. We credit accounts receivable, $17,640, and we credit sales, $360. Why did we do that? Because remember, we originally sold it to them for $17,640 because they said, hey, you know what, I'm going to pay you early. But they decided not to, so we had to make that adjustment. So we increased our sales by that $360 in order to reflect that discount amount that we did, that the customer did not take. Okay. Cash refunds. Oh man, I really don't like having to do that. Sometimes customer comes in and says, hey, you know what? This is broken, got damaged during shipment. I don't like it. It doesn't fit, whatever, right? So if the merchandise is in good condition and I can resell it, I'll give the customer a cash refund. Question? You okay? All right. If I can resell it, it's in good condition, I'll give the customer a cash refund. If the customer purchased the merchandise on account, I can grant the customer an allowance. That reduces the amount on their accounts receivable. When I do that, I need to issue what we call a credit memorandum. Indicates the reason why I'm giving the customer a discount on their accounts receivable or issuing them a refund. Here's an example. On March 4th, our customer paid we gave our customer a refund of $900 for merchandise that was damaged during shipment. The customer decided, hey, you know what? I'm going to keep that damaged stuff and make the repairs to it. That's what the customer said. They're going to keep it and make repairs to it. So we said, okay, but we're still going to give you a $900 refund. So we debit customer refunds payable, $900, and we credit cash, $900. We increased our customer payable refund by $900, and we credited cash to reduce our cash by $900. Customer refunds payable is a liability account. Estimates the refunds that will be paid to customers in the future. What happens is that what companies will do is they'll estimate a certain amount of refunds will happen. It's normal in business. What happens is that let's say we sold a couple $1 million worth of sales, and we expect that 2% of whatever we sold, it'll be returned to us for whatever reason. Customer didn't like it. It's damaged. It's defective. Whatever. So that estimated amount is called customer refunds payable. It's a liability account. In some cases, customers will be due a refund on an accounts receivable outstanding. So instead of giving them a cash refund, we just simply reduce that amount in that customer's accounts receivable account by issuing a credit memo. So in that case, going back to our example, let's say that our customer called us and said, hey, listen, we have $900 worth of defective stuff, but instead of sending that back to you, I'll do the repairs. And they owed us, I don't know, we'll say a couple $1,000. So we'll say, you know what, instead of issuing you a $900 cash refund, I'm just going to reduce it from your total bill for everything else that you owe us. And here's how that would look. We would issue them a credit memo, customer's name on it, the date that we issued the memo, what it was for, and for the amount. And of course, we need to record that. So to record the reduction of their total bill, we debit customer refunds payable to increase customer refunds payable, and we credit accounts receivable for that customer. to reduce their total accounts receivable. About customer refunds. So throughout the year, we expect that we're going to have to issue a certain amount of customer refunds. This is normal. It's a normal part of retail business. So for that estimate, we estimate it based off of the total sales each year. Estimated returns inventory is an asset account that is reported on the balance sheet. Represents the estimate of merchandise that will be returned by the customer. It's recorded at the end of the accounting period in the adjusting process. We talked about the adjusting process in the accounting cycle way back when. I believe it was in chapters 2 and 3. Okay, here's an example. Let's say that on January 15th, a company returned merchandise with a sales price of $3,000 for a cash refund. The merchandise originally cost our company $2,100. Our company would record the cash refund and return the following with the two following entries. We would debit customer refunds payable by $3,000 and credit cash $3,000. Reason for that is because we're issuing the customer a cash refund of $3,000. Then, of course, we need to put the inventory that they're giving back to us back into inventory. So how do we do that? We debit inventory $2,100 to increase inventory, and we credit estimated returns of inventory $2,100. Those are the two entries we make when a customer is asking for a cash refund and they're giving us back the inventory. Oh, sorry. Went too fast. And this is just a nice summary of what we talked about. So if a customer does not return the merchandise and they want a cash refund, we debit customer refunds payable, credit cash. And then we would issue them a credit memorandum by debiting customer refunds payable and crediting their accounts receivable to reduce their overall bill. If the customer is returning the merchandise, debit customer refunds payable, credit cash, and then we debit inventory to return the inventory back to our inventory account, and we credit estimated returns of inventory. And of course, if they bought it on credit, we would just reduce their accounts receivable instead of giving them cash back. Okay, earlier I said we would talk about freight. We mentioned the words FOB, that means free on board. When a customer purchases something from us, we need to ship it to them. There's freight that's involved, whether that's through the U.S. Postal Service or UPS or FedEx or DHL or whoever. We need to get the product to them somehow. So there's a couple things involved with that. Terms of the sale indicate who owns the merchandise while it's in transit. We call this title and control. Merchandise passes from the seller to the buyer at that point. This point determines whether the seller or the buyer is responsible for paying the freight costs. Okay. Ownership of the merchandise passes from the buyer to the seller. Passes from the seller to the buyer when the merchandise is delivered to them. So, in other words, if I sold you a pair of jeans, I'm responsible for what happens to that pair of jeans up until the point it reaches your front door. Okay? In that case, it's called free on board. FOB, free on board, shipping point. This means that the company is responsible up until the point where it reaches its final destination. So, like if I sent you a pair of jeans and I sent it through FedEx, and the FedEx truck caught on fire in the process of getting to you, I'm responsible for the pair of jeans. You're not. Eventually, I'll replace that. Yeah, but it's just an example. That means I'm still responsible for it. That's what free on board shipping point means. Shipping point is also known as the destination, final destination. On January 10th, we purchased some inventory from our supplier. January 10th, we purchased $1,200 of inventory free on board, meaning our supplier was responsible for that inventory until we received it. We paid $50 for the shipping on that. Free on board, it only means who's responsible for it, not who pays for it. That's totally different. I paid for the shipping in this example. So I debit inventory $1,200 to increase inventory. I credit accounts payable to increase my accounts payable by $1,200. I paid for the shipping. So I debit inventory by $50 because it cost me $50 to receive my inventory. And I credit cash to show that I paid the $50 for cash. Okay. Here's another term. This is free on board destination. Destination. Ownership of the merchandise may pass to the buyer when the buyer receives the merchandise. Call it free on board destination. Term means that the seller pays for the freight cost until the buyer receives it. So what this means is that let's say you purchase something on Amazon and it says that shipping is free. We know nothing's free, right? So you purchase something on Amazon, shipping was free. What that means is that the seller paid for that shipping. Yeah? It'll say free on board destination on the packing slip. It means that the seller paid for the freight costs to the buyer's final destination. When the seller pays the delivery charges, the seller, we debit expense and we credit cash. Let's assume that we sell merchandise on June 15th. We sold to our customer $700 free on board destination, meaning that we paid the freight as well. Cost of goods sold is $480. The cost of freight was $40. So we would record the sale. We would debit we would debit accounts receivable. We would credit sales for the $700, right? Then we would debit cost of goods sold $480, and we would credit inventory $480. Then there's some freight involved. So the last transaction, we would debit delivery expense $40 and credit cash. Make sense? Yes? You're all still with me? I know it's lunchtime.
Yes, sir.
Yes.
All right, fantastic. Sometimes the seller will prepay freight, meaning that they'll pay for it before it actually gets shipped, right? The seller will then add freight to the invoice. The buyer debits, we debit inventory. We debit inventory, credit freight. We'll talk more about that. Here's the example. We sold merchandise for $800, terms FOB shipping point, freight was $45, which we added to the invoice, meaning the customer paid for it. And here's how that looks. It's another way to think about when we pay for freight. It's just a third. It's a third transaction, right? That's all that means. Here's a nice graphical representation: free on board shipping point versus free on board destination. Remember, when you hear free on board, whatever shipping point or destination, all it means is who's responsible for it while it's in transit. I'm sure you remember T accounts from, I think it was like chapter 1 or chapter 2. The T accounts represent the normal balance of accounts. For inventory purchases, we debit them. For sales, we credit them. Estimated returns, we debit adjusting entries, credit customer returns. Cost of goods sold, we debit cost of goods sold to increase cost of goods sold. We credit adjusting entry for estimated returns when it gets returned to us. This kind of gives you an idea of what that looks like graphically. Each merchandise transaction, of course, is going to affect a buyer and a seller. What about sales tax? Oh my God, I hate sales tax. I don't like any taxes, to be honest. But okay, so sales tax. Almost every state in the U.S. has a form of tax for merchandise. Almost every state, not all of them. There's very few that don't have sales tax. Okay, sales tax is incurred at the time of the sale. The seller collects the tax from the customer. Seller collects the tax from the customer. When a sale is made, the seller charges the proper tax by debiting accounts receivable and crediting sales tax payable. Here's how it looks. Here's an example. We sold something for $100. There's 6% sales tax. We debit accounts receivable $106. Why 106? 6% of 100 is $6. So we debit $106 accounts receivable. We credit sales $100 because we sold something for $100. And then we also credit sales tax payable by $6 because we collected $6 of sales tax and we haven't paid that yet. Make sense? Hopefully. On a regular basis, very regular basis, usually once a month, sometimes once a quarter, depending on your business. Usually quarterly. Usually quarterly, we got to pay taxes. Go ahead, Dave.
Hey, yeah, I got a question. So sales tax, because I heard this, we haven't paid it yet. Do it gets its own sheet, like far as like, okay, like how you said, every category it's its kids, it's falls under one of the categories, liability or asset. And like you said, we receive it, but at the end of the day, we have to pay it too back to the state.
Yep.
So we will have it will basically like that tax sheet will be on the both of them. We will have a tax sheet for both of them for us, like liability and for the overall
for expense. Yep.
Right. You get what I'm saying?
That's right. Okay. Yeah, 100%. Yeah. So the way it works is so here's how it works, David. So we made the sale, $100, right?
Mm-hmm.
We collected $106 from our customer. Six of those, that $6 is the sales tax, right? So we credit sales 100. We credit sales tax payable 6. Remember, when you hear the word payable,
I mean we have to pay that.
We got to pay that. That's a liability. Right. Yeah, exactly. Okay. You got it. So now the next transaction later on, every quarter, whatever, typically every quarter, we have to pay our sales tax bill, right? The amount, because we're basically taking it from the customer and then we have to give it to the state. Okay?
And that would go on the main. Okay.
right?
Right.
Because if you're paying me sales tax, that's not my money. That's the state's money.
Right. You add up all the sales taxes that you receive for all your payments.
You got it.
And that goes
Yep.
to the taxes that you pay.
Exactly. So from all the sales that I made, I add up my sales tax for that quarter or for that month or whatever.
And when you do your final balance sheet, all of that goes towards liability for real.
That's right. So the way it works is that every time I make a sale, I record the sales amount that the customer paid me,
Mm-hmm.
and I credit the sales amount, and then I credit the tax amount. Those because remember, our debits still need to equal our credits. So
Well, that's
accounts
right.
receivable 106, sales 100, sales tax payable 6, so 106, 106. Then, that $6 that's probably included in this 2,900 that I collected for the month. So at the end of each month, I debit sales tax payable and I write a check for 2,900, cash, to the tax agency, whoever that was, federal, state, local, whatever, whoever I need to pay. So debit sales tax payable to reduce the payable, and credit cash to reduce my cash. And I do that every month or every quarter, depending on what the jurisdiction is. Okay, so that's sales tax. It's not very complicated. It's just something that needs to be done on a regular basis. Wholesalers. Wholesalers are companies that sell merchandise to the public or businesses in bulk, or they sell business to business. Wholesalers, what they do is they'll publish their prices online or in a catalog. They'll put it online. So wholesalers often offer special discounts to government agencies or businesses when they order in large quantities. These such discounts are called trade discounts. An example of a wholesaler would be BJ's Wholesale, Sam's Club, Costco. Those are wholesalers that sell to the public and the businesses. Other wholesalers, they don't sell to the public, but they might sell just to businesses. Like, for example, Jeans and Company is a wholesaler that sells jeans to retailers who then later sell it to you. I made that up, by the way. Okay. Sellers and buyers do not normally record the list price of merchandise and trade discounts on their accounts. So the way it works is, let's say we have a product with a list price of $1,000 and there's a 40% trade discount. Meaning, if I buy in bulk, they'll give me 40% off. That's cool, right? So what they'll do is they'll record the sale at $600. Why 600? Well, 40% of 1,000 is 600. Well, 60% of 1,000, 600. Anyway, sorry. $400 is obviously 40% of 1,000. So they record the sale at 600. Likewise, they would purchase any type of purchase at 600. Adjusting entry for shrinkage. If you hear the word shrinkage or breakage or shortage, shrinkage, breakage, or shortage, it means either theft, or it means something got broken, or it means something got returned. Okay. Inventory shrinkage means the inventory disappeared, whether it was from shoplifting or some other theft or employee error. Sometimes the employee forgot to enter it into the inventory. Yep. As a result, we have to account for inventory that's missing. Yeah. And this is done in both perpetual and the periodic systems. So here's an example of the record that we need to make. The account balance of inventory shows $63,950. We did a physical count and we only found $62,150. That leaves an inventory shrinkage of 1,800. So to account for that 1,800 being missing, we debit cost of goods sold and we credit inventory to put it in, to take it out of inventory because it's not there. After that entry is made, the balance of inventory agrees with or matches the physical inventory on hand at the end of the period. Sellers are required to estimate returns and allowances at the end of the accounting period and to prepare adjusting entries. Number one, the first adjusting entry reduces the sales account and creates a customer refund while it's generated for future use. The second type of entry is second adjusting entry creates estimated return by reducing cost of goods sold. This is an example of that. So here are the two adjusting entries. Debit sales to reduce the sales amount by that amount. Credit customer refunds payable to represent an increase in customer refunds payable. Then we would debit estimated returns inventory and credit cost of goods sold to reduce cost of goods sold. That was okay. Adjusted trial balance. We learned about the adjusted trial balance in the accounting cycle. After the adjusting entries are posted to the ledger, the adjusted trial balance is prepared. And this is an example of an adjusted trial balance. You remember seeing this in earlier chapters. Financial statements. Okay. As we talked about earlier in this chapter, we talked about the income statement for a retailer. Instead of fees earned, we have sales. We have cost of goods sold. Sales minus cost of goods sold equals gross profit minus operating expenses equals operating income. Okay, sales minus cost of goods sold equals gross profit minus operating expenses equals operating income. This is what we call a multi-step income statement because it includes all of these steps. Sales minus cost of goods sold equals gross profit minus operating expenses equals operating income. It's multi steps, yeah? Amount of cost of goods sold to customers is reported in cost of goods sold. So sales minus cost of goods sold equals gross profit. Sometimes called operating income. Minus operating expenses equals operating income. In your expenses, you'll have what we call selling and administrative expenses. Selling expenses include things like sales salaries, stores supplies used, depreciation for store equipment, delivery expenses, and advertising. Those are all examples of selling expenses. Administrative expenses include things like office salaries, depreciation for office equipment, and office supplies used. Think administrative, right? The word administrative, it means office. Other income and expenses are not related to the primary operations of the business. So once in a while, like you'll see this random thing, they'll say other revenue or other expenses. Other revenue would include like things like interest income. You know, you'll have a bank account that earns some interest. That we classify that as other revenue. Or we rent part of our office out to someone else. We sublease it. That would be other revenue for rent. Or we sold a property, plant, or equipment for whatever reason. That would be a gain from a sale of a fixed asset. classified as other revenue because it's not a part of the day-to-day operations of the business. But once in a while it happens, yeah? That's why I call it other revenue. Other expenses would be expenses that we cannot directly trace to the normal day-to-day operations of the business. It would include things like interest expense or a loss from a fixed asset. Remember, fixed asset is property, plant, or equipment. And those types of things show up at the end of the income statement, after your operating income. So sales minus cost of goods sold equals gross profit minus all of your operating expenses equals operating income minus other, right, equals net profit. Or net income, apologies. So we talked about the multi-step income statement, which sales minus cost of goods sold equals operating profit minus operating expenses equals operating income minus other equals net income. That's multi-step, there's multiple steps. We also have what's called a single-step income statement. This just summarizes the total expenses on one line and the total revenue on one line. Kind of makes it easier to read, right? Sales, other revenue equals total revenue. All of your expenses added up equals total expenses. Total revenue minus total expenses equals net income. That's single step. Because we totally skipped over cost of goods sold as being its own item, right? Cost of goods sold is now classified as an expense. It just makes it, I guess, easier to report. That's why you'll see it sometimes listed in single step. But it's better to use the multi-step income statement because it's more identifiable. It's easier to read. We talked a little bit about stockholders' equity in the past. Stockholders' equity, as you know, is the owner's right to the business. And some retailers, they'll issue shares of common stock, like for example, Macy's, Amazon, other retailers that are listed on the stock exchange, and you can purchase shares of their stock. And when you purchase shares of their stock, it's called issuing common stock. It shows up on their equity report. And of course, the balance sheet. We talked about this earlier. But for a retailer, you'll see on the balance sheet, you'll see inventory, estimated returns or inventory. You'll see things like store equipment. And then under liabilities, you'll see customer refunds payable. These are specific items that show up for retailers and manufacturers, but not for service businesses. Go ahead, David.
And all of those, like for under assets, like cash, accounts receivable, all of them have their own sheet. And then you bring all those sheets together to create this.
You got it, exactly. And when you say the word sheet, you're talking about, you mean to say ledger.
Ledgers, yeah. Okay.
Exactly. It means the same thing, exactly. Yep.
All of them have their own ledger, okay.
Got it. Very good. That's correct. Very good. Okay. For a retailer, and we talked about the closing process when we talked about the accounting cycle. I think this was maybe last week or the week before. In the closing process, we debit the revenue accounts and we credit the expense accounts to close them out. Because remember, at the end of every single month, we got to close out our accounts. We post those to our retained earnings. Cost of goods sold gets closed out also to retained earnings, just like an expense would. We would debit our retained earnings account and we would credit our net income to close out to retained earnings, just like before. That's part of the closing process. Works the same exact way. After the closing entries are made, then we do a post-closing trial balance. We make adjusting entries as needed, all that good stuff. You guys remember that stuff. And that's the end. Any comments, questions, or concerns on Chapter 5? Anything at all for retail businesses before we jump into Chapter 6, which is on inventory? And we're going to talk about inventory valuation, stuff like that. And the short answer is yes, we'll finish on time. We'll finish at 1:30. Any questions? Erica, you're good? Okay, great. Okay, I'm going to stop the recording for this chapter, and I'll start the new recording here in a second.